Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
We're going to do exhibit A, B, and C very quickly here because we have much more interesting things to cover this afternoon, I think. I would say exhibit C, the oil demand supply, we've covered every Wednesday. And the things we've worried about, which is the oversupply, the impact on the price of oil, and the lack of growth in China, all is kind of coming to pass. If you look at Exhibit C, we have Russian production declining from 10 million barrels a day in 24 to 9.3 last year and kind of flattening out at 9.2 this year. And we have Saudi Arabia going from 9 in 24 to 10 in 25 and 10.5 in 26. And that increase in Saudi Arabia is made up by the decline in Russia and also a decline from the 13 range to 12.5 range due to reduced activity in the U.S. And even with all that, there's still, a fair amount of, we make it surplus capacity based on these projections for 26 of 2.5 million barrels. So it could be that the impact in oil pricing is already built into the market. The price of oil is, last Thursday it got down to 58. It's now below 57, I believe. The backwardation has gone out of the market. 26 price last Thursday was just down $1. A lot of publicity about Venezuela, but Venezuela is only 800,000 barrels a day. So it really doesn't matter in terms of oil supply. Natural gas, interestingly enough, has been a little weaker despite the cold weather. You can see last Thursday on the bottom of Exhibit B, the near month was around $4.50 and the 26 price was $4. The near month is January, so January is always higher than the average price for the coming year. One of the problems is that LNG into Europe, rather than trading at 10 or 10.5, is down closer to 8. Our largest facility is Sabine Pass. I imagine it's at least $4 in today's market to get gas into Sabine Pass. If gas landed in Europe is $8, it takes $1 to transport the LNG from the Texas Gulf Coast to the Louisiana Gulf Coast to Europe. And then it takes about $3 to liquefy the gas. So pretty close. There's not much margin there. So that's, a ceasefire in Ukraine, Germany and other countries in Europe may begin to work back towards using Russian gas, both pipe gas and LNG. I don't think the price of U.S. gas goes down with the price of LNG, but it's something that we have to worry about. Exhibit A, the government revenues expenses. The deficit is coming down in 26. I don't think there's any question of that, from about just under 2 to right around 1.5 trillion. That's good progress. Nominal GNP is going to be up. Inflation's kind of 3%. So if you get 3% real growth, that's 6%. Your income taxes, your payroll tax, your corporate income tax, all of those should go up 6%. So if you can kind of flatten out expenses, and you'll see their expenses, total expenses, and in 24 were 6.8 trillion, then 7.1 trillion, and then in this forecast it's 7.1 again. Interest in 24 was about 890 billion, about $1 trillion in 25, and about $1.1 trillion. The Federal Reserve coming down with rates is going to help that. One of the things to watch is the expression 2 to 10s. In other words, the differential between a 2-year yield and a 10-year yield. I think it's out around 70 or 80 basis points now. what's going on there is that you can bring the short rates down, but it doesn't necessarily get the 10-year rate down. So time will tell there. We have an interesting 10 minutes here. There's now competition for Nvidia. Google is making their own version of a GPU, and Amazon is in the news yesterday and today for having their version of a GPU and a sale of those to OpenAI. And an investment in OpenAI, which kind of, everyone's thinking OpenAI is going to run out of money. What in the world is Amazon, which is generally pretty conservative with their financings, agreeing to sell them what Amazon calls a TPU to OpenAI. The question I pose to Mike and Jason, I was together and talk all the time. So the question I posed is, alternatives to the NVIDIA series of GPUs, both Amazon and Alphabet or Google use Broadcom, and some part of the revenue there is Broadcom. In fact, I think the chips are made by TSMC, and I think Broadview has that space. And why does Google and Amazon need Broadcom? I don't know what Broadcom makes of it, but let's say 20% of the revenues or something, where NVIDIA doesn't. So with that as an introduction, over to Mike and Jason.
Okay, so this story is really, it's Google versus NVIDIA and their different approaches to AI. And it's less about who has the better chip and more about how each company's evolved and why that history still determines what they must outsource and what they choose to own and where the moat is for each company. On the surface, it looks pretty simple. Google has TPUs, NVIDIA has GPUs, and they're both basically chasing this artificial intelligence compute stack. But underneath, these two companies are approaching the top mark, if you will, of this AI race from opposite sides of the course. And understanding that difference explains not just where these companies have been, but how the next leg of this race is likely to shake out. So Google's native instinct has always been distributed computing. Early Google wasn't about designing hardware. It was about taking lots of off-the-shelf machines and turning them into one logical supercomputer through software orchestration. If you remember, that was the MapReduce era. The breakthrough wasn't a chip. It was the idea that you could split enormous tasks into chunks and run them across thousands of cheap computers. So Google's core competency there wasn't hardware at all. It was architecture and how to spread this work across a fleet of computers. Then machine learning shows up as a new workload, and this workload doesn't scale in the same way. Google realized it had a problem. Internal projections showed that relatively small changes in user behavior, for example, from minutes per day of use of their voice recognition software, would require Google to massively expand data center capacity. So at that point, the team concluded that there would have to be a better way. And that's what pushed them into custom silicon and the TPU. Remember, at this point, Google's hardware is all basically off the shelf. And the critical point is this: TPUs aren't really Google becoming NVIDIA. TPUs are Google making a targeted exception to its software-first worldview. Google is insourcing the part that mattered the most in order to scale these machine learning workloads, specifically the chip, while keeping most of the rest of the stack outsourcing. And that's where Broadcom kind of enters the story. So Google has deep chip knowledge, but it still works with partners on TPU design services and execution, because building a Broadcom scale organization is expensive and slow and not really what Google's culture or core competency is. So this is a classic make versus buy decision, and Google has historically preferred buy and orchestrate over build and own everything.
I guess the point I would have there is they had a specific task they wanted to build a chip for, and that was running neural networks, which did this translation. So that's why they went the path of an ASIC. They wanted a chip designed specifically for running that task most efficiently. And I guess you'll get into Nvidia, but they're selling generalized chips to a large customer base. They want to build something for customers, and Google really in the beginning just wanted to build something for themselves for a specific, problem they had.
So Nvidia, again, on our proverbial race course, is on the other side. They started building GPUs, so very purpose-built chips, but those GPUs for graphics also became useful for parallel computing. And then CUDA happens, and NVIDIA's true product becomes not just a chip, but a developer platform for using this embarrassingly parallel form of compute. And so NVIDIA never stops climbing the stack. First, it's GPUs, then it's full servers, the DGX class systems, then it's racks, then it's entire data center reference architectures. And the biggest tell that NVIDIA intended to own the entire AI data path is the Mellanox acquisition from 2020. So buying Mellanox wasn't just more chips. It was NVIDIA saying, if the future is giant multi-GPU clusters, then you don't just need compute. At some point, AI training and inference is not limited by raw flops. It's limited by how fast all those chips can communicate with each other without collapsing under latency, congestion, software complexity, et cetera. You need networking and scaling. So NVIDIA integrates the GPU, interconnect, network fabric, systems design, and the software stack. That's this concept of an AI factory that we hear Jensen Huang talk about quite frequently. NVIDIA wants to sell you a complete machine for producing intelligence, not just a parts list. So Broadcom, let's just break down Google and Broadcom really quickly. Broadcom isn't the foundry. They don't manufacture the TPUs for Google. Google isn't outsourcing their ideas of the actual design of the chip. Google actually defines the TPU's architecture and the system level requirements. Broadcom is more the in-between. They're the industrialization partner to take it from concept into something that is enterprise-grade, production-ready. And there's unglamorous essential work here: implementation, verification. There's logistics and supply chain. There's a lot of their technical expertise is in networking. They provide some of those IP blocks and actual switches to many of their customers.
I guess, would you say that Broadcom owns that parts list that you mentioned, and just the most important part in that parts list is Google's IP?
So if you're Google, you're trying to solve this large scale problem. And when you recognize that there's no part in the world that does what you want it to do, you may just have to go and design it for yourself. So in that sense, Google owns the vision for what the overall system is. And yeah, after they squeeze everything out of what they could do with generic infrastructure, Broadcom's been integral in turning their custom designs into something that is enterprise ready.
Do you think Amazon uses Broadcom too?
With Trainium, they use Marvell.
Okay.
So there's a number of other companies that do some of this stuff. And actually, notably, not to get too far off track here, their current version of Trainium uses NVIDIA networking. So there's some like overlap of using different parts from different pieces. So I guess just quickly in closing, the question is, where is that, where are we left today? Like what's this next leg of the course going to be? Google's no longer treating TPUs as purely internal plumbing. We know they're available to the cloud customers through Google Cloud, but Google's increasingly positioning TPUs as a product for select customers. So to truly compete with NVIDIA, not just on performance, but mind share and default choice, Google needs more scale. And you think of Google as having massive scale, but chip manufacturing is a business that is extremely dependent on scale. So by actually selling the TPUs, they could get more scale in their purchasing leverage with Taiwan Semiconductor, who's a critical choke point for all of this. In particular, the advanced packaging that they need, both for the TPU and for NVIDIA's chips, is in very short supply, and NVIDIA has somewhere around 60% of that booked up. So NVIDIA's advantage isn't just the GPU, it's the network effect of the platform, the software stack, the system template, the familiarity that all the developers have built over the years. So I'd say the takeaway from all this is that Google grew up as an orchestrator of fleets, and they decided to build TPUs to solve a problem for themselves. And also now are designing their own custom networking in order to keep that orchestration economically viable in this new AI era. NVIDIA, on the other hand, grew up as a component innovator and expanded into an end-to-end AI factory. So for them, performance compounds at all the different layers in that AI factory. So now they're competing, but they're competing with very different approaches and very different DNA. And the question is, what's the end state? We don't really know. It does seem like there's a chance that it's going to be a duopoly, but are they going to be interchangeable? Probably not. Will companies choose one ecosystem over the other? Probably. And will it be more like an Apple Android type of setup? It's hard to say, but I would expect that Google continues to keep pushing their custom silicon division, and again, primarily for their own purposes, but if they can get leverage off of it by selling to other customers, absolutely think they will.
Yeah.
Right. If you're a customer, let's say you're Meta, how do you rank NVIDIA and CUDA against the Google software and their TPUs?
Well, in one sense, Google is a competitor to Meta, right, for advertising dollars. Maybe not directly, but the nice thing for Meta for going with NVIDIA is NVIDIA really has no intent to ever compete with them. The downside is NVIDIA has a lot of pricing power. So if Meta has a workload that is very stable, then they can justify making the investment to basically reprogram the software to work efficiently on a TPU and get that workload off. There's another piece where Meta may not actually be able to get all of the NVIDIA GPUs that they want. So in order to run new workloads, they will take old workloads and shift them over to TPUs or other ASICs in order to free up the GPU capacity.
Which they said they were doing. Well, they didn't say they were doing that specifically, but they are going to purchase TPUs from Google. Mm-hmm. So they're doing something like that. And I don't know if it was a disappointment that Broadcom said they had a new customer, but it was a $1 billion customer. I think if that was actually Meta, people were probably hoping that was going to be a much larger order, since Zuckerberg has said he's going to spend $100 billion over the next year.
Right, but which is why the $1 billion makes more sense, because they may say, okay, we have this, it's called a recommender engine or something they know that's going to be around for a long time. And if they can shift that compute somewhere else, that is a logical and relatively easy to calculate investment decision.
Let's go to page one. It's year end, and Jason has some predictions that we made that we probably wish we hadn't made because they were off the mark. But before we get into that, I have a view here that I think is worth thinking about at year end. Keep in mind, personally, I buy things not very often. I don't think I bought a public stock for some number of years, and I tend to stick with them. Now, I've been very active over my career starting companies and have equities there that grow, but I invest alongside Brian R., as we call him, in Oak Cliff. He and John Jemkoshin are very active, invest alongside Mike and Jason, and they're very active. But I just want to talk about investable assets, family net worth, and the way the world looks. And I don't think it's fair to have Mike and Jason comment on it. So it's just something to think about. And we are going to have sessions next week on Monday and Monday, or the next 2 weeks, to avoid Christmas Eve and New Year's Eve. And so we'll be on at 3:30 both those days. But this is a time for reflection. Given what we've been going through with these 10-minute segments, which have been terrific, and we all owe a debt to Mike and Jason for doing the work necessary. And the way that the world looks, the macro view of the world, I don't think it makes sense to think that equities are too high and that this is the time to sell equities and go to cash or something like cash and figure that somehow the air will come out of the stock market. You have a chance to invest at a lower level. That possibly could happen. Look what happened last April. But then the next question is, how do you allocate? And an awful lot of these 10-minute sessions have been on tech companies. And as I say, Mike and Jason have just done a terrific job of uncovering this stuff. In fact, I don't find some of this stuff, I don't find this in anything I read or podcasts I listen to or anything. So kudos to Mike and Jason. But as investing, investable assets, trying to build up family net worth, I think it will be hard over the next 5 or 10 years to have a good investment result without half of your investable assets being in something like the Mag 6. And I would leave Tesla out just because it's very highly valued and pretty much dependent on kind of blue sky kind of goals. But in addition, you have to think about Netflix. You have to think about Broadcom. There are others, but these companies are so dominant that I think it's going to be hard to have investment results that you're happy with over a 5 or 10 year period without having at least half your investable assets in these companies. Now, the risk is there an IBM in there, or is there an Intel amongst those 6 or 8 companies? And there probably is. I mean, that's what history shows us. But at least at the moment, it's hard for me to say that so-and-so is got that potential to, just not perform at all, the way Intel has not performed, or not perform at all, which is, the way IBM has spent the last couple of decades. And one of the things, we've got other things to cover in the next 2 Mondays, but one of the things to challenge myself and Mike and Jason to kind of discuss where there might be potential in these 8 or 9 companies to really have a really bad result, where you invest in something and at the end of 10 years, it's worth half or less of what your initial investment was. But I've blown through about an extra 5 minutes here. Just going to see if Mike or Jason have any comment on that. And then we can't do these things in short healthcare. So I think after we get their comment, we ought to move to healthcare. But Mike or Jason, they're not going to subscribe to that, nor should they. I mean, they're out there to compound the capital, and they've got to be much more flexible. But how far off base, if we're collecting results of predictions 5 or 10 years ago, how far out on a limb do you think I'm getting?
I actually don't think you're that far out. I think from one perspective, just looking at these kind of call it the top, whether it's Mag 6 or whatever, and just maybe what we need to do is an episode on each one of them and cover kind of what are the existential risks that they face. I think we did a little bit of that actually earlier in the year, and maybe it's time for maybe at the beginning of this year we do a redo of some of that. And because I think the writing was on the wall for Intel, for example, many years before it crashed. And the stock continued to go up, and it continued to raise the dividend, and the quality of the management continued to get eroded. All that happened in plain sight. And I think the point to most of this is, if you're paying attention, then you can be ahead of it. I mean, there are always times when you get blindsided, but for these very large companies that are operating on technological shift timelines, which are decades, frequently you can see what's happening in slow motion if you're looking for the right thing.
That's a great point. I think, but point taken for next year, you want to make sure, let's say there are 8 of these companies, let's say we go from 6 to 8. I think we ought to make sure we do 10-minute episodes on each of the 10, looking, as you say, for existential threats. I think I cut Jason off, but Jason, you don't disagree with that, do you?
No, not at all. It'll be interesting because you can make a case for every one of them. And there is going to be an Intel in there, but I don't think it's obvious today that any of them fit that criteria yet.
Yeah. We'll do predictions next week, predictions that we're embarrassed about, and new predictions. But yeah, so it's a special come on to tune in Monday. So let's, with the remaining 5 minutes or so that we have, let's do healthcare, Jason, so we don't leave healthcare out.
Sure. So today it was actually the IPO of Medline, which is a big surgical supplier and logistics company. And I believe it's actually the largest IPO of the year. They raised about $6 billion. But other than that, there's some news out of the FDA. Something interesting happened this week where last Friday, Johnson & Johnson presented some very strong data on a treatment for multiple myeloma. And it put a large portion of the patients in their trial in full remission for the duration of the study, which was 3 years. So the following Monday, then the FDA reached out to the management of that program, talked about the results of the clinical study, and then granted them a national priority review voucher on the spot. So kind of unprecedented. And then, this new voucher it grants them an immediate review of their new drug application rather than the 6-month accelerated timeline or the year-long process. So I thought it was kind of refreshing to see that, that they can make a decision on a treatment that seems so beneficial and skip, the typical procrastination process that goes on. So that was good news. I think, you can't say everything's rosy at the FDA right now. They're still dealing with a lot of high employee turnover, including at key roles. So it's still kind of turmoil there, but there's some good things happening along with the bad. So, hopefully it shakes out to be a more positive situation than before. And I think these priority review vouchers are part of that.
Good. Well, we're by my watch, we're only 4 minutes over. So we always be a few minutes over, but we'll try to keep it under 5 minutes as a New Year's resolution. We'll do predictions on Monday. Next 2 weeks will be Monday at 3:30. In the meantime, everyone, be well, stay healthy, and thanks very much for listening. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.